I am Dr. Muhammad Hassan Al-Nazim, and I am going to be teaching you the course Advanced Accounting. This lecture we are going to start Chapter 3. Chapter 3, which is the consolidated balance sheets or consolidated financial statements date of accusation. We learned from Chapter 1 that business combination can occur by two methods. The first method is by asset purchase, in which one parent company or one controlling company is going to purchase all the assets and assume all the liabilities of another company. So we have a controlling company and a controlled company. So we cover this in Chapter 2, how to account for the combination through asset accusation. The second method for the combination is through stock accusation. So stock accusation, we have two companies. We are going to call one of them as the parent company, and we have another company which should be called the subsidiary company. So in case the parent company controls another company, both of them will continue to exist, and in this case each of them is going to prepare its separate financial statements, plus the parent company must prepare consolidated financial statements. So in this chapter we are going to know some expressions, and we'll understand how to account for the combination through stock accusation. We start the chapter by some definitions. The first, we talk about the focus of the chapter is accounting for stock accusation. As we said, stock accusation is one method of combination between two companies. One company will control the other company by purchase of stock. So in this case, we are going to have a company that will be called the parent company. This is the company that will acquire the stock of another company. And we're going to have a subsidiary company. This is a company that will be controlled. And in case we have less than 100% purchase of the stock, so we are going to have something called non-controlling interest. So what is a non-controlling interest? Assume that the parent company purchased 80% of the stock of the subsidiary. So in this case, owners of the 20% will be called the minority interest or the minority owners. So we can call them minority interest, minority owners, minority stockholders, or you can call them the non-controlling interest in the subsidiary. So as the first point that we need to know, what's the meaning of the word control? Control is usually occurs by ownership of a majority interest in the subsidiary. So when we have a parent company that purchases more than 50% in another company, so it means that this company will control the subsidiary. But this is actually not the only rule or the only case for the control. So usually define the control as the ability of one company to direct the policies and decisions of another company. So it might happen that we have less than 50% of the stock of another company, and still we can control the strategies and decisions of this company. So in this case, a parent-subsidiary relationship exists. And in this case, the parent will be required to prepare its consolidated financial statements. So the first important point that we need to understand is the control. So both the International Accounting Standards Board and the Financial Accounting Standards Board have indicated their opinion that the definition of control should not be limited to the common presumption in practice of a 50% cutoff, but should instead include an indirect ability to control another entity. So the control might be indirect. We mean by indirect here, assume that we have one parent company, assume that we have B company, and B company controls S company by ownership of more than 50%, and S company controls, let's say, X company. So in this case, B controls S, and S controls X, so P indirectly controls X. So in this case, we have control that does not result from ownership. So P does not own majority interest in X, but still it can direct its decisions. So in this case, X is one of the subsidiaries of P. So the main point here is the control. If one company controls another company, then we have the relationship of parent-subsidiary, and consolidated financial statements must be prepared. Okay. It happens sometimes that we have a company that has a majority ownership, but still it doesn't control another company. So it might happen that we have a company that has a majority ownership interest in another company, but still it cannot direct the policies and decisions of this company. As an example, some companies, when they have loans, so they get some conditions in the loan contract that their decisions will be directed by the lender. So in this case, if you're going to purchase the stock of this company, you cannot direct their strategies. So in this case, you cannot control the company. And in this case, this is not a subsidiary. You cannot prepare consolidated financial statements. Okay, so the purpose of consolidated financial statements. Why we prepare consolidated financial statements? Actually, we prepare the consolidated financial statements in order to present the parent and all its subsidiaries. Assume that we have a parent that had subsidiary 1 and subsidiary 2 and subsidiary 3. So when we prepare the consolidated financial statements, we present the financial statements as if they are all together one economic entity. So we look for the parent and all subsidiaries as if they are one entity. What are their assets? What are their liabilities? What's the owner equity for the affiliated group? So we call this group as the affiliated group. So in the affiliated group, we have one parent, maybe more than a subsidiary, and may have some sub-subsidiaries. So when we prepare the consolidated financial statements, this will give information for the reader of the financial statements as if all of them are one economic entity. Reasons for subsidiary companies. Why companies prefer to have subsidiaries? Why companies prefer to purchase stock rather than purchase of assets? So actually, companies will get the same result. I'm going to control the other company with less cost. So if you're going to purchase the assets and liabilities of another company, you must pay the fair value of all the assets. But if you just purchase 50% of the stock, then you'll pay 50% of the value of these assets, and still you can control the company. So this is why companies prefer to make the combination through the stock accusation rather than just accusation. Plus, when we have stock accusation, both companies, the parent and the subsidiary, will continue to exist. This means that the parent company will be liable only for its liabilities, and still the liabilities of the subsidiary will be the responsibility of the subsidiary. So stockholders of the parent will have less liability, will not be liable for all the liabilities of the subsidiary. Plus, many tax benefits can be achieved, tax benefits. If we have one company losing company and another company winning company, so the tax payment will be lower. So we have tax savings in case of the stock accusation. So the reasons for subsidiary companies: advantages to acquiring a controlling interest in the voting stock of another company rather than its assets or all of its voting stock. So stock accusation is relatively simple. This is one more advantage. So it's very easy to purchase the stock. So you can go to the market and purchase the stock in a second. One day you buy the controlling interest and that's it. No need for official procedures to acquire another company. But in case of asset accusation, you should have negotiations between the board of directors of the controlling and the controlled companies. So board of directors of the two companies must negotiate about the price, about the conditions, about everything. So why should you bother and go for negotiations and have hassle and have long time? So if you have money, you can go to the market, just buy the stock, then you control the subsidiary. So stock accusation is relatively simple. Control of a subsidiary can be accomplished with a smaller investment. We said instead of paying 100% of the subsidiary, we just purchase 50% of the stock, then we control the subsidiary. And still we have separate legal existence of the affiliates. And this provides the element of protection of the parent's assets. So these are all reasons why a company should go for the stock accusation rather than asset accusation. Actually, we must take care that the consolidated financial statements do not substitute the statements prepared by each one of the affiliated groups. So, if we have all these companies in one affiliated group, still, each one of them is required to prepare its separate financial statements, plus prepare consolidated financial statements for the whole group together. So this is very important. Each company still prepares its own separate financial statements, plus we prepare the consolidated financial statements for all the companies together. Recording the investments in a subsidiary. Actually, we have a very important rule that the parent company records its investment in each one of the subsidiaries at cost. So we record the investment that we make in any one of the subsidiaries at cost. And what's the cost? Cost is usually defined as the consideration given or consideration received, whichever is more clear. So sometimes we purchase the stock from another company and we pay cash. So cash is very clear. We paid this amount of money. Sometimes we issue some stock of our company. Okay, so in this case, we go for the market and know how much is the price of the stock. It's clear. But assume that the stock is not active in the market. So we can't have here an active price. We can't know the fair price of the consideration given. So the rules that we have, the cost would be the consideration given or the consideration received, whichever is more clearly evident. The consideration given might be cash, might be other assets, might be debt securities, in case we have some bonds that will be issued for the owners of the old company, might be stock of the acquiring company, or usually to be a combination of all these methods of payment. When we have accusation of the stock of another company, actually we have some source of costs that we are going to pay. We said in chapter 2 that we have 3 types of costs. We have direct costs, we have indirect costs, and we have stock issuance costs. So direct costs relate to a specific accusation. So when we acquired S1, we paid this amount of money for the consultants, for lawyers, for accountants, for a specific accusation. So these are direct costs. And sometimes the company might have a combination department. This department has a job of finding subsidiaries and completing the procedures for the combination. So the costs of this department are allocated to all the accusations occurred during the year. So the amount that will be allocated to each accusation is indirect cost. So direct costs, indirect costs, and sometimes we have stock issuance cost. So to issue stock to the stockholders of the subsidiary, then we are going to pay some money for the banks, for the issuers, for the mediators that will issue the stock. So three categories of expenses: direct and indirect, and the stock issuance costs. We said in chapter 2 that both direct and indirect costs will be expensed as incurred. So direct and indirect costs will be expensed as incurred, will be recorded as an expense when they are paid. But for the third type, stock issuance costs, so will be a reduction of the other contributed capital. So both the direct costs of acquiring the stock and the indirect costs relating to accusations, such as costs of maintaining an accusation department, should be expensed as incurred. So we have an exercise. The exercise in the book, exercise 3.2. This is on page 110 in the book. So in this exercise, we said that on January 1, 2014, Polo Company purchased 100% of the common stock of Save Company by issuing 40,000 shares of its $10 par value common stock with a market price of $17.50 per share. Polo incurred cash expenses of $20,000 for registration of the stock and stockholders' equity section of the two companies' balance sheets on December 31, just before the accusation, are as follows. Okay, so let's agree that whenever we have any exercise for the accusation of the stock, actually we must make a comparison between two important values. We make this comparison in a schedule that's called computation and allocation of the difference between stock acquired and the price paid. So we are going to prepare a table called computation and allocation of the difference between. So we are going to compare two values. We are going to compare between the implied value of the companies that we purchased and the book value of the assets and liabilities purchased. So we call this schedule as CAD or CAD schedule. So in the CAD schedule, we will make comparison between two values. So I'm going to compare the implied value of the companies that we purchased and the book value of the companies that we purchased. So what's the meaning of the word implied value? Implied value. Implied value assumes that I tell you that we purchased 50% of the stock, one company, and we paid $1 million. So if I paid $1 million to purchase 50% of the stock of a company. So this means how much is the value of the company total? It would be $2 million. Because I purchased 50% for $1 million. So the implied value is the value of the company acquired, derived by the price paid and the percentage acquired. So the implied value is equals the price paid, or the consideration given, divided by the percentage acquired of this company. And the book value of the companies that we are going to acquire is usually measured by the stockholders' equity on the date of accusation. So equity of the subsidiary on the date of accusation. Equity includes the common stock, other contributed capital, and retained earnings. So whenever we have any case of stock accusation, I must make this comparison. Compare the implied value of the companies that we acquired, compare that to the book value of the company acquired. Whenever we have any comparison between two values, I have three cases. So case one will be the implied value equals the book value. So it might happen that we purchase 50% of the stock and we pay it 1 million, so the implied value is 2 million. And the total equity accounts of the subsidiary is 2 million, so they are equal. Or case 2 might be the implied value is greater than the book value. So we paid more than what we have in the book value. Or case 3, we might have the implied value lower than the book value. So I have 3 cases for the stock accusation. And in each one of them I have subcase. What's subcase? So in case 1 I have case 1A. If I have implied value equals book value and the ownership is 100% of the stock. Or case 1B, implied value equals book value and we purchase less than 100% of the stock of the subsidiary. The same for the 2 other cases. So we have case 2A, if we have implied value greater than the book value and we purchase 100% of the stock. Or case 2P, implied value greater than the book value and we purchase less than 100%. The same for case 3, we have 3A and 3P, 100% or less than 100%. So what would be the difference between the 3 cases? So in case 1 I don't have a problem. The amount that we paid equals the book values that we acquired. So I don't have a difference to allocate. The price we paid equals the book value acquired. The problem will be in cases 2 and 3. In case 2, the price we paid is higher than the book value acquired. Price we paid higher than the book value acquired. We learned in chapter 1 and chapter 2 that we are going to have something called the goodwill. The difference is recorded as a goodwill. But take care. Goodwill that we had in chapter 1 and chapter 2 is the difference between the price paid and the fair value, not the book value. Fair value of the assets acquired. So, in this case, we are going to have something that we are going to call the differential. Differential between the implied value of the book value, and we are going to allocate this differential. Some of the differential will be used to raise the value of the assets from the book value to the fair value. Then if we have more differential, this will be allocated as a goodwill. And in case number 3, we used to call that, the 2 chapters, as bargain purchase. So the bargain purchase, we are going to record gain on the accusation. So we are going to learn how we are going to deal with each one of these 6 cases. So we have actually 6 cases for the combinations through asset accusation. So let's apply that to what we have here. Here, we said that we purchased 100% of the common stock of S company. 100%, so we are in case A, one of these three cases, might be 1A or 2A or 3A, because we purchased 100%. And the price we paid, we issued common stock. We issued 40,000 shares of common stock, and the common stock has par value $10 and market price 17.5. So we want now to find how much is the implied value and how much is the book value acquired. So let's make the comparison that we have here. So in our case here, in exercise 3.2, the implied value equals the price we paid 40,000 shares. So 40,000 shares multiply the market price per share, which is 17.5. Multiplied $17.5 per share. This is the price paid. Divided by the percentage acquired, so divided by 100%. So how much this will be? So 700,000. Can we calculate? So if you multiply 40,000 by 17.5, $700,000 divided by 100%, so the implied value is $700,000. And we want to find how much is the book value acquired. So the book value equals the equity accounts of S company. So on the date of accusation, this is the equity of the parent company, and this is the equity of the subsidiary company. So I have 320,000 plus 175,000 plus 205,000. So this equals $700,000. So the implied value equals the book value. So we are in case 1A. We are in case 1A because the implied equals the book value and the ownership is 100%. Okay, now we are required to prepare the journal entry for the accusation. So in all cases, whether case 1 or 2 or 3, A or B, in all cases, the journal entry to record the accusation will be the same. Journal entry to record the accusation will be the same. What's the entry? The entry will be debit, investment, and what's the name of the company? Save. Investment and save company. This is debit. For how much? The amount we paid is 700,000. So debit 700,000. And credit will be the consideration given. So what's the consideration given? We gave common stock. So the entry for the issuance of common stock is credit common stock for how much? Common stock will be credited for the par value of the stock given. So we have the par value per share is $10. So multiply $10 times the 40,000 shares. So 40,000 times $10, this is $400,000 credit to common stock. And the difference between the par value and the market price is credited to other contributed capital. So 300,000 will be credited to other contributed capital. So the entry for the purchase of the stock of safe company, so we consider this purchase as an investment. So debit, investment, and safe company. And credit the consideration given. So consideration might be cash, so credit cash. Might be stock, so credit common stock and other contributed capital. And might be bonds, so credit bonds payable. So the rule, debit the account, investment, and S company, credit the consideration given. Then, in this case, we have also some expenses related to the accusation. I have $20,000 cash expenses for registration and issuance of the common stock. So this item, or the type 3 of the expenses. So type 3 of the expenses will be recorded as a reduction of the other contributed capital. So the entry for these costs will be debit other contributed capital, credit cash for the amount paid, which is $20,000, $20,000. So these are the journal entries to record the accusation of 100% of the stock of S company. So we have two journal entries. Entry number 1 would be constant in all cases. Debit, investment, and S company, credit is the consideration given. And entry number 2 would be there if we have the consideration in the form of stock. If we issue stock, we'll have stock issuance costs. That will be a reduction in the other contributed capital. Okay, so this is what we call the journal entries for the accusation of the stock. Well, now we want to prepare consolidated financial statements. I want to prepare the consolidated financial statements of the two companies, the parent and the subsidiary, on the date of accusation. So to do that, the consolidated balance sheets, actually we are going to use something called the work paper. Work paper to combine the two balance sheets together and prepare one balance sheet. So the work paper will look like that. So we are going to have the balance sheets of the two companies listed in two columns. One column for the balance sheet of the parent company, one column for the balance sheet of the subsidiary company. Then I'm going to have two columns for eliminations. Elimination, what do we mean by eliminations? Eliminations means that some items will be eliminated from the balance sheets of each company. So I'm going to eliminate some items from parent company balance sheet and some items from the balance sheet of the subsidiary. Then I combine them to prepare what we are going to call the consolidated balance sheet. So this is the complete form of the work paper. So the work paper will include actually 5 columns. Column 1 for the balance sheet of the parent company. Column 2 for the balance sheet of the subsidiary. Columns 3 and 4 for the eliminations. And column 5 would be for the consolidated balance sheet. Okay, so what are the eliminations that we should have? Actually, we have some items that must be eliminated from the balance sheets. Now, we said that the consolidated balance sheet is prepared as if the parent and subsidiary together are one company. Okay, so the account that we have, investment in S company, the account appears in the balance sheet of the parent. But when we combine the two companies together, I cannot have an account called investment S company, because P and S are now one economic entity. So we must eliminate this account. So I'm going to eliminate from the parent company investment in S company. And at the same time, I have the owner's equity of the subsidiary should be eliminated. So the eliminations that we're going to have will be as follows. I am going to eliminate from the parent company accounts the account called investment and subsidiary. And versus that, I'm going to eliminate the equity accounts of the subsidiary company. So this is the first and most common type of eliminations that we are going to have. So the elimination means some items will be removed from the balance sheet of the parent, some items will be removed from the balance sheet of the subsidiary. The first and most common elimination is to eliminate the investment in S company from the parent company balance sheet and eliminate the equity accounts from the subsidiary company. So we are going to apply that now in our case. But before we go there, we have some other eliminations that must be made. These are not here in this case, but we're going to have them later. First, sometimes we have intercompany receivables and payables. So I have the parent company gave some loans to the subsidiary. So this will be recorded in the parent company as accounts receivable and in the subsidiary as accounts payable. So if they are one economic entity, we are going to remove the receivable and the payable. So we're going to remove them because it's one company, one economic entity. Sometimes we have advances. So if we have advances to or advances from, so the parent paid advances to the subsidiary and subsidiary received advances from the parent. So we remove advances to and advances from between the two companies. Sometimes we have interest. If company S has a loan from company P, so company S will pay interest to company P. In this case, the interest will be recorded in the parent company as interest revenue. And in the subsidiary will be recorded as interest expense. So if we combine the two companies together, I should remove the expense and the revenue from the two companies. Sometimes we have dividends. So in case we issue stock, like this case, when we issue stock to the subsidiary, then for the subsidiary company, they are going to have dividend revenue or dividend received. And for the parent, to be dividend declared. So we should remove or eliminate the dividends received and dividend declared from the two companies. Sometimes you have sales between the parent and subsidiary. The sales will be recorded in one company as revenue, and the other will be recorded as cost of purchases. So we should eliminate these items for each other. So it's all called eliminations. So for our case here, to prepare the consolidated balance sheet, so in our case here, if we want to prepare the consolidated balance sheet, I have in the parent company the account investment in S company for 700,000, and I have in the subsidiary the equity accounts, common stock, other contributed capital, and retained earnings. So we should eliminate investment S company for the equity accounts from the subsidiary. To do that, we are going to make something called elimination or eliminating entry. So the eliminating entry, what you're going to do, I want to eliminate the account investment in S company that appears in the balance sheet of the parent. So this account has a debit balance. So to eliminate this account, I must make it credit. So the credit side of the entry will be investment S company. And we have the subsidiary, the equity accounts. These have credit balances. So to eliminate them, we must make them debit. So the eliminating entry will be as follows. Debit, common stock of safe company, which is $320,000. And debit other contributed capital of safe company, which is $175. And debit retained earnings of safe company for $205. This is the debit side of the entry. And credit investment in safe company for $700,000. So this is the entry that we must make to eliminate the intercompany accounts in order to prepare the consolidated balance sheet on the date of accusation. Question: where will we record this entry? In the books of the parent company or the books of the subsidiary company? The answer: none of them. So it will not be recorded in the books of the parent and not be recorded in the books of the subsidiary. So where we are going to record this entry? Actually, the entry is recorded only on the work paper. So this is a work paper entry would be recorded here. And the two columns of the work paper in the eliminations that we have in the work paper. So take care. It is looking like a journal entry, but it is not a journal entry. It's not a journal. We don't record this entry in the journal. We record this entry only on the work paper to prepare the consolidated balance sheet. So the eliminating entry, it looks like a journal entry, but it is not a journal entry. This is an eliminating entry. This is a work paper entry, just prepared to eliminate the intercompany accounts in order to prepare the consolidated balance sheet. Well, so now we have the idea of the parent and the subsidiary and the control and the stock accusation and the journal entries to record the accusation of stock. Well, we have here an illustration other than exercise 2.3. Assume that on January 1, 2015, P company acquired all the outstanding stock, which is 10,000 shares of S company, for cash of $160,000. What is the journal entry would P company make to record the shares of S company acquired? So we are required to prepare this entry. Okay. So we agreed, before we can have any step, I must make the CAD schedule to find which case we are in. Are we case 1 or 2 or 3? So let's do that. So this is the illustration. We paid the price, $160,000. So the implied value will be $160,000 divided by 100% because we purchased all the stock of S company. So this is $160,000. This is the implied value of the subsidiary. And how much is the owner's equity of S company? So owner's equity of S company, we have $100,000 common stock. Other contributed 20,000, turned the earnings 40. So 100,000 plus 20,000 plus 40,000, so they are $160,000. So again, they are equal. So again, we are in case 1A, because we purchased 100%, and the book value equals the implied value. Okay, so we don't have goodwill, we don't have bargain. So we are in case A, case 1A. So let's go for the journal entry. What will be the journal entry to record the accusation in this case? We agreed the journal entry will be usually the same. Debit, investment in this company, and credit the consideration given. So in our case here, the journal entry will be debit in S company. For how much? We paid $160,000. So debit, investment in S company, $160,000. And what will be the credit? We paid cash. So credit will be the consideration given, which is cash. Credit cash. $160,000. So this is a journal entry to record the accusation. Very good. Now, we want to make the eliminating entry. Eliminating entry will be the same. Debit, the common stock of S company, and other distributed capital of S company, and retained earnings of S company, credit, investment, and S company. So it's the same entry that we usually have. So debit common stock, 100,000. Debit other contributed capital, 20,000. Debit retained earnings, 40,000. Credit investment in S company, $160,000. So this is the eliminating entry that we have in this case. So now we learned how to make the journal entry to record the acquisition of the stock, and how to prepare the eliminating entry that's required to prepare the consolidated balance sheet. So the eliminating entry, as you agreed, is not recorded in journals. It's recorded only on the work paper. So this is a work paper to prepare the consolidated balance sheet. We have 5 columns as we agreed. First column is the balance sheet of the parent company. Second column, the balance sheet of the subsidiary. Then 2 columns for the eliminations. So I'm going to make this entry in these 2 columns. So debit, 100,000 common stock of S company, 20,000 other contributed capital of S company, 4,000 retained earnings of S company, and credit in the parent company, 160, the investment in S company. So total debits must be equal to total credits of the eliminations. Then the consolidated balances will be just we add the numbers to find the total assets and total liabilities and total owner's equity. So cash, we add cash plus cash. Other current assets, plant and equipment, land, investment in S company, it was an account in P company, but it was eliminated. So in the consolidated balance sheet, it will not appear. We don't have investment in S company in the consolidated balance sheet. Then liabilities are added together. Then all the owner's equity of S company are eliminated. So what will appear in the consolidated balance sheet is the equity accounts of the parent company only. And of course, the total assets must be equal to the total liabilities and equity of the consolidated balance sheet. So this is the first example of how to prepare the consolidated balance sheet. Take care that the eliminating entry, this is what we just written here, debit common stock, other contributed retained earnings of S company, credit investment S company from the parent company books. And remember, this is a work paper only entry. So it's made only in the work paper. It's not recorded in the journal, like the journal entries that we have here. So note the following on the work papers that we just prepared. Investment account and related subsidiary stockholders' equity have been eliminated. So we eliminated the investment in S company from the parent, and we eliminated the equity accounts from the subsidiary. Subsidiaries' net assets have been submitted for the investment account. So we remove the investment in this company because we got all the assets of the subsidiary. Consolidated assets and liabilities consist of the sum of the parent and subsidiary assets and liabilities. So for each type of assets, we add them together to find the consolidated. Consolidated stockholders' equity is the same as the parent company's stockholders' equity. Consolidated balance sheet is that of the economic entity. So the consolidated balance sheet is for the two companies together. This is for the economic entity of the two companies together. Okay, so this is the first case that we have for the preparation of the consolidated balance sheet. So next lecture, inshallah, we're going to continue with other cases for the same problem. Thank you so much.